10 principles. These 10 principles are not just mine, but the common ground of many great traders. Not rules, not tips, principles. The difference matters. A rule tells you what to do and what not to do. A principle tells you how reality works. And if you understand how reality works in trading, the rules build themselves. These 10 principles are not mine. They are about the structure of the market itself. And every trader who achieves real consistency has internalized them at a cellular level, not intellectually, cellularly. Your brain knows them so deeply that acting against them feels physically wrong. That is where we are going. Let's begin. Principle 1. Every moment is unique. Look, this might sound simple, but most people deep down do not want to accept this. Because the more uncertainty there is, the more danger we perceive. So accepting that we are in a rigged game makes us feel better. Because if something is rigged, at least it is predictable. We think there is no total chaos. However, even if the trading game is rigged, every moment is unique, and this will always be so. You must accept and embrace this reality. You see a double top. You have seen 1,000 double tops. Anyone who learns a bit of technical analysis knows what this means. In the classical sense, for technical analysis, this means a drop. But this time, it does not drop. It breaks higher. And if you are someone who moves with technical analysis, you sit there confused. But there is something you missed. That pattern might look identical to yesterday's, but the players creating the order flow right now are completely different. The conditions are completely different. Different traders, different institutions, different algos, different risk appetites, different information, a different time. The visual similarity is an illusion. The outcome is independent, so every moment is unique, and those who seek certainty will never find it. On the contrary, those who embrace uncertainty and uniqueness make progress. They are more at peace with trading and handle results better, even if they are negative, because they are prepared. Meet Alex. He trades breakouts. On Monday, a breakout setup appears. Clean resistance, volume confirmation. He takes it. It works, makes $300. On Tuesday, the exact same setup appears. Same chart, same time frame, same visual structure. Alex takes it, loses $200. He is furious. What changed? Visually, nothing changed, but that does not mean nothing changed. Invisibly, everything changed. Monday's buyers are not Tuesday's buyers. Order flow is different. Liquidity is different. Narrative is different. Conditions have actually completely changed. The image being the same alone means nothing. Monday's outcome has zero predictive power over Tuesday, but Alex's brain does not accept this. His brain sees patterns and assumes causation. This way, he comforts himself and approaches the game this way. Because this means confidence. Because this means some things can be certain, can be known. And our brain wants to believe this is real. Because this makes it feel safer. And this approach emotionally and financially destroys thousands of traders every day. Because every moment is unique. There are no exceptions. The sooner you accept this, the sooner you stop expecting the market to repeat itself just because it looks the same. Principle 2. Transfer the energy. You have old beliefs, beliefs like I can predict the market, beliefs like this pattern always works, beliefs like I am on a streak. These beliefs have energy. They feel true, but they are wrong. And as long as they have energy, they will control your behavior. They will find ways to exist and want to seep into your reality. Your job is to pull the energy out of those beliefs and transfer it into these 10 principles, not just understand them, believe them. At a cellular level. Yes, not saying everything is probability, but knowing it is so. For example, not believing in these principles, but knowing they are real and accepting them at an internal level. If you reach that stage, everything has already changed for you. This is not intellectual work. This is reprogramming. When Alex sees a double top, his old belief says, this will drop. That belief has energy. It feels certain. The new belief says, this might drop or it might not because every moment is unique. The new belief needs more energy than the old one. How do you build that energy? Repetition, evidence, experience. Every time the old belief fails you, you feed the new one. Every time the new belief protects you, it gets stronger, for months, for years. Until the new beliefs are not beliefs anymore, they become your operating system. Sophia used to believe she could predict the market. That belief had massive energy. It felt true. But every time it failed, she transferred a little energy to the new belief. Anything can happen. 2 years later, the new belief became stronger than the old one. Now when she takes a trade, she does not expect it to work. She accepts that it might or might not, and that acceptance makes her execution flawless. The energy transferred. The old belief died. The new one runs her now. Principle 3. Disconnect the relationships between trades. The outcome and process of one of your trades is probably affecting your other trade. And the truth is, if you want to move to a higher level, you must not do this. Trades are independent of each other, and how well or poorly things are going should not have an effect on this. You win 3 trades in a row. Your brain whispers you are on a streak. You are hot. The next one will probably win 2, or you lose 3 in a row. Your brain whispers, you are cursed. The market is against you. The next one will probably lose 2. Both whispers are lies. Each trade is independent. They have no relationship to each other. Winning 3 times does not make the 4th trade more likely to win. Losing 3 times does not make the 4th more likely to lose. But your brain is wired to see patterns, to connect dots, to create narratives, and those narratives destroy your execution. So do not give space to narratives. How your last trade concluded has no importance and should not. If it does, you will never capture the results your system promises. Marcus wins his first 2 trades of the day. Feels great. 3rd trade appears. It is a 70% setup. Normally he would pass, but he is on a streak. So he takes it. Loses. 4th trade. 60% setup. He's rattled now. Thinks his streak is broken. Passes. It would have won. Marcus is not trading the setups anymore. He is trading the story his brain created about streaks. And stories are not strategies. Your job is to execute your edge regardless of what happened before. The previous trade is dead. It has no influence on this one. Disconnect them. Every single time. How much your account is up or down should not affect how you manage your trades. This is not simple, but if you constantly remind yourself of this, you will see each trade as separate probabilities. And at the end of the day, when a trade closes, the emotion of that trade also closes. Do not carry the trauma or euphoria of the previous trade to the next one. Do not allow this. Principle 4. Analysis is just a guess. This might be the hardest one to accept. You spend hours on analysis. You study charts. You draw levels. You calculate probabilities. And all of that work matters. But at the end of the process, you are still guessing. Technical analysis does not predict the future. It estimates likelihood. You are not saying this will happen. You are saying this is more likely than that. And more likely is still a guess. It can be wrong. Traders who are blindly attached to their analysis normally lose much more than they would lose. On the other hand, traders who can interpret the market objectively regardless of conditions can immediately switch sides and turn a losing analysis into profit. We must be flexible. We must not fall in love with our analysis. This is a guess, and we can be wrong. And this is quite normal. To be a profitable trader, we do not need to always be right. Remind yourself of this. 5 of your 10 analyses can fail, and if you manage risk correctly, you can be profitable this way too. The math says so, and you know this very well. Elena does flawless analysis. Her entry is perfect. Her stop is logical. Her target is reasonable. The trade loses, and she thinks she did something wrong. But she did not. Her analysis was a guess, and guesses can be wrong even when the process is right. The goal is not to be right every time. The goal is to be right more often than you are wrong over a series of trades. 1 trade proves nothing. 100 trades prove everything. Your analysis is a tool to tilt probability in your favor, not a crystal ball. Act accordingly. Do not expect miracles. The miracle analysis you seek that will never be wrong is not real and does not need to be real for you to be profitable. Realistic expectations create less disappointment. Principle 5. Your edge is a probability, not a certainty. Your strategy gives you an edge. That edge means one outcome is more likely than another. It does not mean that outcome is guaranteed. If your edge wins 60% of the time, that means 40% of the time it loses. And if you find it abnormal when you lose, the problem is with you, and you cannot predict which individual trade falls into which category. You only know that over a series, 60 will win and 40 will lose. So all you have to do is act independent of the outcome of trades and operate your edge. Sounds simple, but all traders know it is not simple. If certain price movements still trigger certain impulses in you, it means acting this way is difficult. But you will get there over time. Over time, price movements will have no effect on your emotions and impulses, and you will be able to operate your system optimally in all conditions. This is a skill that takes time and is definitely the biggest skill in trading. No matter what conditions, emotions, and impulses say, you must stay loyal to the plan. Liam has a strategy that wins 65% of the time. He takes a trade. It loses. He thinks his edge is broken. But it is not. Thinking his edge is broken because of one trade or 5 trades is actually an incredibly irrational and absurd thought. But he cannot see this, because he wants to escape the negative emotions and feeling of failure he is experiencing. Yet a scenario that could happen has happened and everything is progressing normally. He should not feel such emotions. But learning not to see a losing trade as failure will take time. His edge never promised this trade would win. It promised that if he takes 100 trades, 65 will win. 1 loss means nothing. 10 losses might mean nothing. The edge reveals itself only over volume. Liam's mistake is judging his edge on sample size of 1. You cannot evaluate probability with 1 event. You need dozens, hundreds. Your edge is not about this trade. It is about the next 100. Principle 6. Anything can happen. Anything can happen always, and if you ignore this possibility, experiencing absurd events is inevitable. Everything you assume will not happen to you will happen to you. Because trading is largely about this, until you accept that anything can always happen and make peace with it. A single order from a single trader anywhere in the world can reverse the market. An institution deciding to exit a position, an algo detecting a signal, a central bank announcement, a tweet. The market does not care about your analysis. It does not care about your chart. It cares about order flow. And order flow is unknowable. You cannot predict who will place what order and when. So the idea that something is certain to go up or certain to go down is a biological trap. Your brain craves certainty, but certainty does not exist in trading. Only probabilities exist. Sophia has a perfect setup, every indicator aligned. Trend, support, volume. She is certain this trade will work. She even tells herself it cannot fail, and because she is certain, she risks 3% instead of her usual 1%. The trade fails, stops out immediately, and Sophia is devastated, not just because she lost money, but because her certainty was shattered. Here is the truth. The setup was fine, the analysis was fine, but anything can happen. A whale could dump, news could drop, liquidity could vanish. Sophia's certainty was not confidence, it was delusion. And delusion always gets punished. Anything can happen. Accept it before you click the button. Not after. Principle 7. Be reconciled to spend money. Every trade costs you money to find out if it will work. That cost is your risk, your stop loss. And you must be willing to pay it before you enter, not hoping you will not have to, knowing you might. If you are not okay with losing that $200, do not take the trade, because hoping the market will not take it from you is not a plan. It is a prayer, and prayers do not work in trading. Maya enters a trade, her stop is $150, but she is not really okay with losing $150. She is hoping she does not have to. So when the trade moves against her, she moves her stop, gives it more room. The market takes 300 instead of 150. Reconciliation means accepting the loss before the trade starts. If you cannot accept it, the position size is wrong. Shrink it until the loss feels like a business expense, not a tragedy. Do not create new trauma for yourself. Do not take risks that will be psychologically difficult for you to tolerate. Do not wear yourself out for nothing. This road is a long road, and you will definitely need your psychology on the road. Do not waste it. Principle 8. Kill the need to be right. Trading is not about being right or wrong. It is about executing your probabilities flawlessly. You can be right about direction and still lose money if you manage the trade poorly. You can be wrong about direction and still make money if you cut fast and move on. Right and wrong are ego traps. Profitable and unprofitable are the only metrics that matter. Daniel takes a trade. It immediately goes against him. His analysis says it should bounce, but it does not. Old Daniel would hold, because admitting he was wrong felt like failure. New Daniel cuts, takes the loss, moves on. Was he wrong? Maybe. Does it matter? No. Because his job is not to be right. His job is to protect capital and execute edge. Right and wrong are for academics. Traders care about outcomes over a series, not validation on a single trade. I would rather be wrong and make money than be right and lose money. Anyone sensible would. Do not attach importance to being right. If you lost money and your analysis was correct, you failed. Sorry. You should work on your execution, not on your analysis. Most traders who have been exposed to markets enough can do good analysis with their own methods, but because nobody thinks enough about the execution part, we mostly have problems in that part. And this is quite natural. Do not overload meaning onto analysis and mentally prepare yourself for the execution part. Principle 9. Order flow is unknowable. You do not know who is placing orders. You do not know how much they are placing. You do not know when they will place them. This unknowability turns every trade into a probabilistic event, not a deterministic one. You cannot control the outcome. You can only control your process. Ryan sees a massive buy volume candle, thinks institutions are accumulating, goes long. The price drops. Turns out that buy volume was not accumulation. It was someone closing a short. Ryan could not have known that. Order flow is invisible. You see the result. You do not see the intent. And without seeing intent, you cannot know what comes next. This is not a weakness in your system. This is the nature of markets. Accept the unknowability. Build your strategy around it. Stop pretending you can see what is invisible. If you noticed, many principles are actually talking about the same thing. Do not see uncertainty as a bad thing and embrace it. Make peace with it and love it. Principle 10. Either way, I am fine. If you truly believe in probabilities, then whether this trade wins or loses does not shake you emotionally. Both outcomes are part of the system. A win is expected. A loss is expected. Neither is good or bad. Both are data. This emotional neutrality is the final stage of trading psychology. When you reach it, consistency becomes inevitable. If you are not affected by outcomes, your winning is inevitable. Because your edge, as you know from data, will make you profitable. And the only obstacle in front of this is you. And the moment you become independent of outcomes, this obstacle is removed. On the other hand, if you stop out 4 times in a row, and when you should take the 5th trade, you hesitate and miss it, and that trade hits take profit, you have ruined the entire statistics. So do not care how many times you have lost in a row. Keep operating your system. Jordan takes a trade, it wins. He feels nothing. Takes another, it loses. He feels nothing, not because he does not care, but because he knows both outcomes are normal. His strategy wins 58% of the time, so he expects wins and he expects losses. Emotional reactions only happen when reality violates expectations. Jordan's expectations match reality, so reality cannot disturb him. Either way, he is fine. This is the state you are building. When both outcomes feel the same, you have internalized probability. These 10 principles are not a checklist. They are a lens. When you internalize them, you see the market differently. Losses stop feeling personal. Wins stop feeling like validation. You stop fighting reality and start working with it. Every trade becomes an execution of probability. Not a test of your worth, not a prediction. Not a guess that must be right. Just a probabilistic event in a series of probabilistic events. And when you stack enough of those events, consistency emerges. Not because you got smarter, but because you stopped lying to yourself about how the market actually works.